Hello.
Hey, how's it going?
Very good.
Good. Just gonna give a few minutes for people to show on up, and then we'll get started.
No problem. I'm Jack Marr, by the way.
Nice to meet you, Jack. Thomas Croessmann.
Is my name up on my screen like yours is?
Yes. But
Oh, okay. You see my name. All right. I wasn't sure if that was on there.
Hey, did anyone else get, there was like a Zoom invite link from Cindy? Or no, I'm sorry, from Angela. I'm looking at Cindy.
Yeah, they needed the other Zoom link for the government Fairfax thing. So they asked us to set up a separate link.
Okay.
They're using that one for the government job.
Okay. So I don't need to be on that. I was like the only one on that and very confused.
How's everyone doing?
Good.
Good. I got to hang out with your father the last few days.
He wants to join this call, and I sent him the Zoom link, so I need to let him know to get on this.
To get on the Teams link.
Yeah.
I will eventually mute the phone, but I'm like so tired of text messages from the field today. I'm like, go ahead and done.
Yeah, I will say I am also cooking dinner and have a toddler under feet, so I will be muting myself, but listening very attentively.
No, that's great. So the hope is that this, we're going to give our presentation, but we do want questions and like a roundtable type discussion. But
well, if you were a part of the last one, it was very lively, so I don't think you'll have any problem.
Good. Good. My worst thing is I just give the presentation and then nobody has any questions. So
no, a lot of times we interrupt too because we're just that kind of crew.
That's great. Well, this, it's legal and accounting stuff. It's not the most fun, but it'll be good.
No, I don't know. After we saw the last one and it was trying to value the company, I was like, yeah, I'm not ready to sell the company yet.
Yeah.
I seem to have got disconnected. I'm back.
There you are.
All right.
The day will not end.
I know that feeling.
How many people are signed up?
I think we're having 8 or 9.
Oh, wow. Okay.
How many was in the last group? I wasn't able to attend.
I want to say we had probably 4 or 5.
Okay.
Yeah.
So it wasn't bad. And if you're here, then Angela has the recording of the last one too, and it's really worth going back to watch.
Yeah.
Hey, Thomas, are you able to send this link to my dad?
Because
I'm having a hard time forwarding it to him.
I can check. I am not a techie person. I had my admin sent it out.
Copy it and I'll put it in an email to him.
Well, I don't know how to do that with Teams. Like we use Teams all the time, and I tried hitting the forward, but it's
as well, so I can't do 2 teams
I
at
just
once.
couldn't paste it. What's his email? It's not auto-populated.
dmerrick@mdbi.us.
I'm sorry. Say it again, Addie.
dmerrick@mdbi.us.
There, now it populates.
Okay.
Right now.
Cindy's trying to send it to
let me see what I can
you
do.
over here.
There you go. Let's see if that worked. Because I'm not on Teams, I'm just on the link here. So he
Right.
should still, even if he doesn't have Teams on, whatever he's gonna be on, he should be able to get in.
No, there's no retaining wall.
There's also, I mean, if you go to my calendar, there are 3 of them, and
New
one
fence,
of
and that's
them
on
is
the
from
drawings.
Catherine
Yeah.
Kathy Schmidtman,
Nice.
and that has the Teams link in it.
Yeah.
Yeah, I can delete the other ones.
All right.
Okay, now there should just be one thing. Are you still there? There's still one thing on the calendar, and that has the link in it.
Did we lose Jim again? His icon went small.
I'm going to give Michael a call to see if he's having a problem joining, and we'll be right with you all.
Okay. Well, there he is.
Hey, Michael, good timing.
Hey,
I was
how's it
just
going?
calling to make sure you got the right link.
Yep.
Fantastic. And then Mr. Marr dropped off. It looks like he's coming back on.
Yeah, see, I have 2 now, and one of them would not have helped.
Yeah, that last minute switch is always tricky. All right. Looks like David's joining. Hello, David.
I pay extra if both Addie and I are on.
Yep.
Hey, Keith.
Hey everyone,
How's it going?
good. How are you guys?
Good. Now, is everybody else hearing a buzzing?
Yes.
Yes.
I am.
All right.
Let me see if I mute myself if it's me, because I've had fan noise. So hold on.
Yep, that's it.
Yeah, it's you.
Cindy.
No, it's not me. It's
Cindy.
me. All right, I'll keep myself muted and I'll just chime in when I have a question.
Perfect. So I'm always a sucker to give people a couple minutes to join that are running late. So we'll get started promptly at 4:05.
Okay, I know Jenny from Spectrum is joining.
Okay, great.
She just wanted to do it from home, so she's left the office and going home. Does I've never used Teams before. Does anybody know how to change the view?
Yeah, click more. You want like a background?
No, I just want something. I've got big. I can't see everybody.
Click on
And
the.
then-
You should see 3 dots on the top. It says more,
Mm-hmm.
and then there's a gallery at the top, a full screen. It doesn't have as many options as Zoom, that's for sure.
Okay. Thank you.
There's a large gallery. Maybe that might be better. I don't know if you see.
Oh, that's,
Okay, the large gallery put us all in a stadium. It was awesome.
that's what I just did. I'm sticking with that. Oh man, it's like I'm in like a rock garden stadium. Yeah, Cindy, are you there too? That's pretty cool. I don't know if I can handle it though. It's a little trippy. I'm having green tea. I think I need to add something to it if we're going to stay in this particular green location.
Give us about 30 minutes. You might need it.
I was gonna say you might need it with the topic. I mean, it's tax and accounting. It's super awesome, right?
Exactly. Hey, Cindy, I've started seeing Robin Gelman right across the hall from you.
So why haven't you knocked on my door?
It's always dark. I'll send you a text before I'm coming next time.
Okay. Yeah, we're rotating people in and out of the office, so that's usually why.
Okay. Yeah. And I usually go late in the day, but she's awesome. So my former acupuncturist retired after seeing him for like 20 years. And I saw 2 or 3 people before her, and I give her a big thumbs up.
Yeah, it's funny. She's married to a guy that my husband works with. They're both in news. So small world when she ended up moving into that space.
Yeah. Yeah.
Very cool. Well, I guess we'll go ahead and get started. Thank you, everybody, for joining. For those that don't know me, my name is Thomas Croessmann. I'm with the law firm of Croessmann and Westberg. We're a construction law firm. We're a full-service firm. So we help contractors with everything from contracts to selling and buying businesses. I'd also like to introduce Michael Callahan. Michael, do you want to introduce yourself?
Yeah, thank you very much, Thomas. Michael Callahan with Intentional Accounting. We provide outsourced CFO services, including accounting, bookkeeping, and payroll, as well as business and individual tax planning and preparation. Appreciate everyone joining today. Looking forward to talking about taxes.
Yeah. So how many were in attendance of the last first speech we had with Doug Howard and about how to build your value? Let's see, Cindy was anybody else? Okay.
I was there.
All right, great. So this is going to be something that builds upon that. For those that weren't, basically he talked about how to build a sellable business and get good value for your business. And so how do you do that? You know, some things are taking the owner away from the business and having systems so that the business can run without the owner. And how are you going to monetize your business, and how do you get growth so you can sell it for what you need to sell it? That's a nutshell. Okay. So what we're going to be talking about here for the next couple hours is or less, Keith, if you need less than that.
I just need to turn my phone off.
Is how do you go about selling your business from the legal and the accounting side? So we're not going to be talking about how to build value, although I'm sure some of these things will help with your value, but they're going to be on the structuring side mainly. So one other thing to note is we're going to be focused mainly on you selling to a third party, an outside party, different than succession necessarily internally. You can do that, and a lot of these documents that we're going to be talking about would be used if you were, say, selling it to either an employee or a family member, but it would be a shortened process. And that's typically because the family member that's buying it usually has more intimate knowledge, so you're not doing a long due diligence process, which we'll be talking about. You wouldn't necessarily do a letter of intent. You would kind of go straight to the purchase documents and the actual transition documents. But for the topic of this conversation, we're going to be talking about selling your business to an outside third party. So we're going to go through all of the various steps so that everybody has a good understanding of the process. So before we do that, we're going to be talking about structuring that you're going to want to think about for years prior to actually getting ready to sell. All right. And so what does that mean from structuring perspective? Well, most companies that come to us, and Michael, I'm sure you're probably going to reiterate this, but I certainly would love to hear your position. They come to us as what we call solo firms. So what does that mean? That is a term we have coined. It is not something you'll go out and find in the workplace. A solo firm is somebody that has their real estate in that one company, their equipment in that one company, and their operations all within one company. So, and that's a fine structure. There's nothing wrong with it. But depending on your desires and your needs, there may be better structures that you want to talk to your professional advisors about. So what are some of those structures? What might they look like? Well, some of them may look like if you own land or building, you may put that building in a separate LLC. And if you own a whole bunch of equipment like backhoes, trucks, you may put that into a separate LLC or corporation. Doesn't have it can be either. And then you would have your operation business separate. So what would that look like? You'd have your operations over here. You'd have your equipment over here. You'd have your real estate over here. And what they would do is they would lease the necessary things to the operational business. So if you had your trucks, your operations would lease those trucks from your other entity. Same thing with the real estate. Your real estate would lease the building to your operational business. You could also put a holding company above that. And so what is a holding company? A holding company is a term that gets thrown around a lot, but it's a very simple concept. It is a company whose sole job is to own the individual shares of those three companies. So let's do a really stupid example, okay? John Smith, as an individual, may create a holding company, John Smith Enterprise. And the John Smith Enterprise's job is to only own the shares or units of whatever companies he creates down below. He's a contractor, so he has an operations business called John Smith 1. He has an equipment business that is John Smith 2 that holds his trucks, his bulldozers, whatever pieces of equipment you have. And then he has John Smith 3 because he has a building that he leases. Well, all of those are still owned by the holding company. Okay. Now, there's a lot of good reasons to do this from a liability risk mitigation perspective. That's outside of the scope of this conversation. But when you isolate all those, your risk for a lawsuit exposing those assets become lower. But for this perspective, why might that be beneficial in the selling of your business? Well, because now you have a lot of options that are not available to the solo firm. With the solo firm, you're selling everything because that's all you have. You have it all in one entity. But when you have these different entity structures, you can either sell components or all of it together. So, for example, you could just sell off the real estate, keep the operations and the equipment business going. Or you could just sell off the operations and you keep your equipment and your real estate going. So the one that I typically see is where they sell off the equipment and the operations, but they keep the real estate. Now, why would that be beneficial? Well, beyond the purchase price, what you now also have is reoccurring revenue because you're getting that lease money and you're still the owner of it, but you sold off the operations and the equipment. You could do the same thing with the equipment, but that we see a lot less. But having it separate gives you options. And that's one of the most important things when it comes to creating these transactions. Michael, I know I've done a lot of talking to this point. Why don't you talk on the tax aspects of the creating different structures?
Before we do that, does anyone have any questions on what? And feel free to, I think Thomas, correct me if I'm wrong, feel free to interrupt. We're a small group here, so you guys can interrupt with questions at any point.
Yeah, please do.
I'll interrupt first thing. So if your company is a corporation, either an S Corp or a C Corp, right? Do you still have the flexibility, if it's not an LLC, to break it into those things?
Yes, you do, because the S Corp versus C Corp is just a tax election. That's Michael's realm. But whether it's a corporation or LLC really doesn't matter. I use the term LLC because that's just something, it's very flexible, and so a lot of people use it. But you can certainly use a corporation. And it's not really breaking it apart. All you're doing is you're creating another entity and then selling those assets or transferring those assets to that other company to create these separate verticals.
Has anyone been involved in a sale of a business before?
No.
Keith has?
Well, not a construction business, but yes, I have been involved in the sale of a business.
Good. Was it a good transaction or?
It was good for the majority, the big guy. It wasn't so good for me. No, it was fine. It was fine. But
Yeah.
it was a very interesting process. We almost sold first to American Express, and then it ultimately sold to a company called Payment Tech, which is now bought by US Data. But it was I got to participate because I could reject any offer because that was the structure of what I had built. But it was fun.
So, and based on Thomas's explanation there, does anyone have that kind of structure where there's a holding company and other entities underneath of it at this point? No one?
Not me.
Well, I would comment, no, I don't, but the way I would pursue, would pursue the real estate is just through an LLC that was owned by me personally. Do you have any objections to that?
Not from the legal structure side, no.
I wouldn't sell the building and the business together. I don't think anybody here has enough equipment because we're all light construction, but selling the business, but you don't sell your cash though, right?
Four-part seminar about
What? You could.
not, selling your business or handing it off. That's succession.
Well, I can't hear that. Sorry.
Yeah, I couldn't understand that either. But Keith, to answer your question, you could be selling your cash. And that's just part of the negotiation that you're really going to want to watch. So, and that's something that is surprising to the clients is, okay, we're going through the transaction. You have to leave $500,000 of working capital in there for them to operate with. And they're like, well, yeah, hold on. I thought I was taking that $500,000. It's like, yeah, but then you're leaving the company gutted and they're not going to be willing to give you the price you're asking for without that. So good comment, Keith.
So from a tax perspective, there's lots of different reasons to have entities separated. I could do a whole, separate talk on the tax implications of that. For purposes of just overall organization, I would say a very large number of clients come to us with lots of different entities, lots of administrative costs because they're not organized with a holding company. And that's one of the biggest things I see from a tax perspective is ideally you have the holding company, even if you're not sure, what the future looks like. I always recommend having that holding company and then, having an operations company underneath it just from the beginning, even if you don't, you have no idea what could happen, because the ideal scenario would be for that holding company, as it grows and as you have more income, I would say one of the easiest planning ideas for a CPA is to convert to an S corporation. And again, I could do a separate webinar on that, but the long and short of an S corporation is it saves you self-employment taxes. And if you have multiple entities that are all generating profit, then you would want all those entities, if you don't have a holding company, to be an S corporation, which means you've got a separate tax return. You've got to have the officers have to get compensated through salary. Lots of administrative costs come into effect every time you set up an S corporation. So the ideal structure would be the holding company is an LLC that at some point when it makes sense and it's being profitable, then that entity would be make the S election to be taxed as an S corporation, so that all the income, whether it's from a holding or whether it's from an operating company or a real estate company, all that income flows into that S corporation, and you're getting the savings all through that one entity. You only have one payroll. From an administrative perspective, it simplifies the process. The other, any questions?
Michael, let me interrupt you for 1 second because that was going to be a question. So if you've got in Thomas's explanation the 3 different companies, right? So are they creating 3 different tax returns and then the holding company is a 4th, or you're saying that everything's getting channeled up and then it's just one?
It depends on how those are structured. If the holding company is the sole owner and they're LLCs, it's disregarded for tax purposes. So there is no separate filing for any of those returns. They would all flow in to the holding company and only one tax return. And a lot of accountants will recommend that you have partnerships, or so then now instead of having one instead of having one tax return, now you have 4 tax returns. So from an administrative perspective, that's 4 tax filing fees, for potential payrolls, like lots of administrative costs. Whereas if it's just a single member LLC owned by the S corporation, there is no separate filing. It's completely disregarded for tax purposes. Now, if you have a partner if you have these operating companies and you have partners in there, there would be a separate filing for those. But if it's only one owner, then it would just all flow up.
And Michael, you could have a partnership up in the holding company, though.
Absolutely, yeah.
And that's how you would probably structure it if you had the same owners for each entity. And Michael can speak to this a lot more, but depending on whether you're a partnership or an S corp, the nice thing about partnerships, I'm not a huge fan of them, but the nice thing about them is it does allow you to distribute the profits differently, where an S corp doesn't. So if you have a partner and you guys are getting different amounts of those distributions, you certainly want to seek somebody like Michael's advice. But and to be clear, I did a 3-prong example with equipment. The vast majority of the times that I see somebody come to us, it's 2. It's real estate and then the operating business. A lot of my remodelers don't have enough equipment to really justify putting it in. Although I'm seeing more and more that are buying trucks, and those can really justify having a third entity. But for example, if you just have like one truck that's worth 20 grand, maybe not.
What is the value that you think would warrant? I've seen Dave's trucks around. I know I'm guessing he owns them, Dave and Addie's trucks. I've got a couple $100,000 in vans and trucks. Is that worth an entity?
I would think so.
Okay.
Yeah, mainly because what you're looking at is twofold. When you set up the entity for the equipment, you're really doing more of risk mitigation and liability protection than you are for the sale. But you wrap it into the sale component, right? But for that kind of amounts of equipment, yeah, having a separate entity could add some nice isolation for you.
Mm-hmm. We're actually being sued over a car accident from like 4 or 5 years ago.
So that's the idea of the liability, the protection, is that they can't sue you for an accident, or is there more to it than that?
Well, there's more to it than that. More of it's less assets that the operating business has to go after. So like, let's say you're working on somebody's house and you bungle the job and they sue you. Well, what assets do the operating company have for them to come after? If the equipment is in a separate LLC, they can't get that without doing a lot more work to try to go get it.
What about the reverse example that I just gave you, which is Spectrum is being sued because of a car accident from 4 years ago? Yeah,
so there's a lot of complications that could go into that analysis.
Okay. You can save it.
It's a little beyond the scope of this conversation, but happy to talk to you offline about it because it is an interesting one.
All right. So my next question, still in this topic of division, right? Because Keith brought up the idea of, well, I as the individual am going to purchase the real estate that my company will be working out of. Is there a benefit to having an individual owner that will continue to hold on to that property after the business is sold, still keeping it separate and not a part of the holding company, but then it would go on personal taxes or whatever? Is there a benefit to doing that versus having the building being owned by, I guess at that point in time, the LLC and being under the umbrella of the holding company?
Yeah. So to be clear, even if you're buying it to hold, I would always hold it in some type of LLC. So I would never buy it as Thomas Croessmann buying this building. But
why?
Why? Because then you have limited liability versus exposing all my personal assets. So like, let's say I buy a commercial building to run my law firm out of. By putting it in an LLC, I isolate it so if something happens during that, either something trips in that building or the building burns down or some problem arises, they can't go and grab my house that I live in. Okay, so you always would want to have it in some type of entity to separate it from yourself. But whether you put that in the holding company or not is going to be part of that long-term strategy of, well, if I'm going to keep it, then maybe I put it in the holding company, maybe I don't. but that's just something you're going to have to talk to your advisors about, because you can also get into this trap where you're going down this legal path and you're doing all this stuff because lawyers tell you, but then they totally disregard the CPA side, and it makes it 1,000 times more complicated for the CPAs, and you end up spending a ton of money for a marginal amount of risk mitigation.
Or taxes.
Or taxes, right. So
the other big thing that we advise on too, and I'm not sure, Thomas, how much you've dealt with this, but is putting IP into a separate entity. Like if you guys have like some type of internal training that's really specialized for your industry, it may be a good idea to house that in a separate entity, because if you sell the operating company, potentially similar to the real estate, that could be reoccurring revenue where you're training their employees. So that's definitely.
Yeah, good examples are like patents, trademarks, those things you could put into a separate LLC. In fact, if you guys go to Dunkin' Donuts tomorrow, look at the bottom of their cup. It'll say like DDIP Inc. And that's exactly what they did. All of the trademark and logos are all in a separate LLC from their operating company. But that's a great example. So we're still in the early structuring phases. This is pre you finding a buyer and maybe even looking for a buyer. One thing that I also want to point out that we see come about at the very end that's always surprising to people is assignability clauses in contracts. Now, this only applies really to asset sales, which we will discuss in a few minutes. So I just want you to put that note if you're taking down notes. This only applies to asset sales. But assignability clauses in contracts say they usually say this, neither party can assign this contract to any other person. And that is to help bind them so that it's you and them working together. So you can't assign the obligations, you can't assign the money. While that's great in the normal day-to-day operations, that can be a real problem if you come time to sell, and in an asset sale, which we'll talk about, you're selling assets, one of which is contracts. You may find that you can't do what you're trying to do. And a lot of people don't realize that until the due diligence phase, when they're looking through the contracts and they go, oh, none of these can be assigned without me going and getting the homeowner's approval. And that's a real bear of a problem. So something to just keep in mind. That does not mean that I recommend do not have assignability clause, anti-assignability clauses in your contracts. I would certainly recommend it. But as with most businesses and remodeling in particular, they're time focused, right? I mean, projects don't go on forever. So as you start getting closer to going, all right, I think I'm going to sell my business, then maybe is the time that you start modifying your contracts. Does anybody have questions about that? Keith?
So it took me a second to catch up. You're talking not about someone makes you an offer to buy your business, letting them assign it. You're talking about our individual contracts with our clients?
Correct. And your subs and everything. And again, it's a little premature for us to be talking about, but I wanted to put it on people's radar, and we'll talk about it more when we get to asset sales. But that's something that is an early stage thing that you want to think about, because if you look at your subcontracts, you may not be able to assign those. And as part of asset sales, you're going to be selling your assets. Well, what are your assets? Your assets are contracts. And so you may run into that problem where, oh no, now I have to go and get everybody's approval, and the buyer is certainly going to put that onus on you, the seller. So does anybody have questions about these early structuring issues that we've been discussing?
I did want to mention one more thing about the holding company. Another great reason to have that holding company is for potentially like discretionary items that a potential buyer may or may not have. For example, your personal vehicle expenses that are being used for the business, your personal cell phone, all those expenses ideally would run through that holding company. It does two things. It makes the operating company more profitable, and when you're going through your due diligence, they're going to pull some of those items out when they when they're doing the valuation. But it makes it really clear. And also, like, you know, throughout your business life, if you're getting any type of bank financing and you're providing financial statements, that information won't be in the operating company's financial statement. So from an operating perspective, you're more profitable. So I just wanted to mention that as well.
Yeah, absolutely. Now, we are throwing around terms like due diligence. I'm going to define those in a few minutes. So if you're like, hey, what does that mean? We will get there. But Keith, did you have a question?
I do. So some of this has got to be volume related. Some of this level of complexity. I mean, do you have any benchmarks that we should be thinking about? I realize we're in the same market, but you know, I don't really care. Like, these start to sound like $5 million, $6 million ideas. Cindy, in the first call, I wasn't there, but I watched the YouTube, and you said, didn't Keith change his name? Well, Vaughn Group was essentially a holding company for Vaughn Construction, Vaughn Management, TBG LLC 1 through 7, right? And there were different investors, and when it unraveled, it unraveled. So it was a little too early to create that level of complexity, even though it worked for 5 or 6 years. When it unraveled, it was hard to unravel.
Yeah.
So I guess my question here is, like, are you talking 5-6 million? Because that's what it sounds like to me, because there's a level of fees and advice and forms and corporations and all of that stuff.
So that's a great question, Keith. I think you could lower it to about 3 million.
Okay.
But yeah, I mean, look, this is what I kind of meant by that comment earlier of you could structure this to death from a legal and accounting side, but the gain might be marginal, right? So here are some really good rules that we use internally. You buy real estate any type, regardless of the amount of money that you have as a business. You put that in a separate LLC. So the equipment is really the one, and then the holding company. There's not actually as much structuring as you think involved, because to create an LLC or a corporation, either one, you know, is fairly minimal, and the tax savings may pay you back far more. So your ROI might be there. You already have your operations company, all of you do. And then it just becomes the equipment is really the big question mark. And that is not so much determined on a revenue basis of like 3 to 5 or 7, you know, whatever million. That could just simply be what are you holding for equipment. I have companies that do $20-30 million a year, and I think their only piece of equipment is one $40,000 truck. And that's just because they have their subs do it all, and so they're not holding any equipment, and so they don't need a separate company, right? So it is a little bit revenue dependent, but that's mainly because you're usually not buying yourself a building without some decent revenue to get a loan usually.
And I like to recommend the holding company from day one, regardless of revenue, because if you just have a holding company and an operating company, again, those can be just, if they're both LLCs, potentially you don't have any separate returns. It's still on your Schedule C on your individual return if an individual is the sole owner of both of those. And then you can build off of that and add complexity off of that later. You can make the S election and file the S corp return later. All that can be done later. So it's really, from a cost perspective, it's really minimal to set up the holding company and the operating company underneath of it.
Yeah. Now, Keith, I mean, what it sounds like with you, which I have no knowledge of, but like, it sounds like you had 7 or 8 companies under that holding company. No?
Oh yeah, no, it was a disaster.
Yeah, that can get really complex.
It was basically, I wrote a business plan, and a guy who was an accountant and a lawyer structured it. And then I went out and started doing it, and it was great until it wasn't. And then when it wasn't, it was really bad. And the new people, the new advisors were like, this is overly complex.
Yeah.
That's all. I mean,
yep.
For what you were doing and for you know, X, Y, and Z, and you know, it was just too complicated.
Right.
Michael, I have a question. Is there ever a situation where the organizational or operational entity is the S Corp and the holding company is the LLC, or is it always usually reversed?
I like to see it reversed because again, the S Corp helps mitigate self-employment taxes. And if, you know, you have two different companies underneath of it that are both profitable, the ideal scenario would be you'd have to do an S corporation for both of those, which means you'd have to get, if you're the officer of the corporation, you would have to get a salary, and then there would be separate tax returns. An S corporation, even if there's one owner, has to file a separate return. So now you're talking about two returns needing to be filed, potentially three with the holding company as well.
And just a little bit of tidbit of the future talk, you're going to see why having a separate return will be very valuable during the due diligence period, just for privacy. But we'll get there in a second. Does anybody else have any question about the kind of okay, Keith?
I got one more question.
All
so
right.
let's say Jenny, are you taking notes? Okay. Let's say we set up a holding company, because I'm an S Corp. Let's say we set up a holding company. Would I take my salary from both or from one of them? And which one would be better?
So ideally, the holding company would be the S corporation, and your salary would come from there.
Okay. And then would I change the designation on the spectrum and make it an LLC?
Potentially, but that could trigger tax consequences. So I don't want to say for sure.
Okay.
Depending
So I
on,
could keep them both as S Corps, right?
you could, but then now you've got separate returns.
I have Maryland, DC. I mean, I got so many returns. That's, you know, doesn't matter.
And then,
Okay.
and potentially, with anytime you have multiple entities paying payroll to the same person, you're potentially overpaying in state unemployment tax. So that's something else to be thinking of. I mean, it's not a huge number, but it's tax you don't have to pay otherwise. So it's something to consider.
Well, there's a number that we stop at in terms of salary for a variety of reasons. So we've already done that. So anyway, okay. Sorry. I thought it was a good idea to set up the holding company. But I didn't want to understand that fact first.
Yeah, this is a great discussion. So, all right. So now that we've got this kind of pre-structuring done, now we're going to go into actually forming the deal. Okay. So where do you start? Well, a lot of the clients that I work with, they start by actually finding a broker. So you certainly could just, you know, find another party that's looking to buy and avoid the broker, but so that everybody has a good, clear view of what some of the steps are. There are brokers out there whose sole job is to match buyers and sellers. So that's a good tool to use if you don't know who to sell to. The thing that you really have to watch for is their compensation. And this is not a dig at them. I work with a lot of brokers. They're great, and they certainly earn their commission. But when the deal falls through, that's where it becomes a really big problem. So here's a story for you. A lot of brokers will take somewhere between 8 to 12%. And that's just what I've seen. It does vary based on the size of the deal. So typically the larger the deal, the lesser percentage they're willing to take. But so let's use 10% as a round number. I did have a client who signed up and with a broker, and the broker found a person. And the way that their agreement was structured with the broker was that the compensation was due when essentially the LOI was signed. Okay, and we're going to talk about what a LOI, a letter of intent, is. But the point is the deal fell through, and it was an $800,000 purchase price. The broker was entitled to 10%. So that's $80,000 that my person was now on the hook for, and he did not receive the money to pay him. And so that was a big problem. So again, not a ding against the brokers. You just need to really understand when is the compensation due, and how are you planning on paying for it? If you're planning on using the proceeds of the purchase, well, that needs to be negotiated out very clearly, because otherwise you could find yourself in a situation where you're owing a ton of money on something that you've lost out on. And again, that was after we had done a whole purchase agreement. There was a lot of legal and accounting fees on top of that. By the end, the person was out $100,000 and had nothing to show for it. So now you have your broker. They have put you together with a potential buyer. What is the next step? The next step is typically what is called a letter of intent. They're also called memorandum of understanding, but letter of intent is the more prevailing term. So what is an LOI? An LOI is a very simple document, usually 1 to 3 pages. And it includes the major terms that are going to go into the purchase agreement. So what are some of those terms? What is the purchase price, right? That's what a lot of people care about at first. Is it a cash deal or is it a finance deal? If it's a finance deal, is it bank financed or is it seller financed? What are the type of terms that might be contingent upon? For example, do you have to get a loan at 5%? Those types of things. Then it also may talk about what is the due diligence period. And we're going to talk about what due diligence is, but it's the period where you go and you gather the documents to assure that the company is worth what you're buying it for. So what is that period? Is it 90 days, 180? That's typically what I see, is about 90 to 180 days, somewhere in that realm. How is the deal going to be structured? Is it a stock sale or an asset sale? Now, we'll define what each of those are when we talk specifically about what a stock sale is and an asset sale. But they're really important to know ahead of time, and you put that in your LOI because that'll have a massive impact on Michael's side on how he's going to structure the tax ramifications of that. And then one of the other terms you may include is there a transition period with the owner? So what does that mean? Well, a lot of the times you're going to have a transition period where you as the owner are going to stick around to do the nice handoff of your clients and of your employees to the new buyer. You could certainly have a thing where you just hand it off and say, hey, there's no transition period at all. But typically what we see with smaller businesses, about a year, 6 months to a year. Sometimes it can be longer. I mean, it can be 5 years or whatever you all negotiate. But the point of the LOI is to have these very major terms already negotiated so that you can hand that off to the lawyer and the CPA, and then they can go about structuring the 20, 30-page purchase agreement that you're going to end up having at the end. Now, again, as I mentioned at the beginning, this is for a deal selling to a third party. If you're selling to a family member, you may or may not have that. It's really up to you. The other thing that you might include in your letter of intent that I forgot to mention was you can either do it as part of the LOI or you can do it as a separate agreement, and that's a non-disclosure agreement, an NDA. And that is to keep everything confidential that you're going to be providing to the other side, because you're going to be providing them a lot of in-depth knowledge. I mean, you're going to be opening your books, you're going to be sharing with them your trade secrets, and you want to make sure they don't go and use that if the deal falls through. So having an NDA will be very important. Keith.
I mean, assuming the sales price is based on some combination of assets, net profit, and EBITDA, wouldn't you want to put a confidentiality in place before you ever had a conversation?
So I would love that. But that's not how a lot of times they come to me. A lot of times they go, hey, we're going to sell it and it's $800,000. And there's almost no real basis other than seller said, I want $800,000 for my business.
I got you. Okay.
So, yes. Primarily, you'd want an NDA as soon as you do it. And a lot of brokers will actually supply that to you prior to us getting it. The reason I have the NDA in here is that if you don't have one beforehand.
Okay.
But, and brokers will, depending on what their style is, they may do a lot of the due diligence ahead of time. And so if they do, they will be providing an NDA that is signed between the parties. But some brokers really don't do a lot of due diligence in between and provide a lot of information. They just say, this is what I have, and do you want it or not?
Right.
Hey, Thomas,
I've
is
been,
there a
I've been approached
consideration
by
during the
brokers
LOI?
twice.
Oh, I'm sorry. Andrew?
I'm sorry to jump in there, Keith. Is there a consideration that takes place at the LOI? So is there any deposit that goes down?
No, I mean, not really. It's just a letter of intent for mutual. The LOIs by themselves are generally not binding except for the confidentiality components. So it really is just to get the base terms out, but you're not doing any kind of consideration like, let me put down $50,000. You may do that as part of the purchase agreement where we're going to do the purchase agreement, and then there may be a component of due diligence still going on during the purchase agreement. So you're going to give me like $50,000 now, and then you'll give me the rest at closing. Okay. So does anybody have any questions about the LOI stage, the NDA, the brokers?
I was just going to say that I've been approached twice by brokers, and they were pretty thorough in their efforts to do due diligence. Like
The good ones are.
precursors, hour-long, like everything was in place to have those conversations.
Yep.
So, anyway.
And that's just depending on the style and frankly, whether they're good or not. Like we did a deal late last year. We closed on a $30 million transaction for a client, and those brokers had an entire database with everything. So that the buyer could go in and look at anything they wanted to look at. And that was well before we had even gotten involved. So,
cool.
All right, Michael, any comments about the LOI?
No, I mean, obviously, if you're paying for anything out of pocket, then it's fully deductible, or would offset purchase price if you're paying a broker. So that's about it.
Yep. And I certainly would recommend that you have an accountant prior to the LOI involved, because those things like whether you're doing a stock or an asset sale, the financing, all of that will have implications that you're going to want to have already discussed with your CPA, as opposed to bringing him or her a purchase agreement at the end and saying, is this okay? And having them trying to figure it out. And I know that those all sound kind of like ridiculous examples. They happen to us all the time. All right. So now you got your LOI, you hand that off to the attorney and they can start drafting. So
Thomas, interrupt for just a second. Sorry.
Yep.
One other thing about brokers, I've dealt with several clients who the broker has either recommended a valuation be prepared, or they actually prepare one in-house. And so I would definitely, if they're going to prepare one in-house, I've seen some of those in-house fees for valuations be extremely high when they weren't necessarily. So if a broker wants to do that and they do it in-house, then I would definitely recommend getting a couple of opinions on costs for those valuations.
What do you think they should be?
I'm sorry.
What do you think they should be? Like if there was a retainer type, so you call the broker, say, I want to purchase, X company, this revenue, this number of employees. I don't care if they're profitable or not. What should you pay them to do, to go after that company for you?
Well, if they're looking for a company for you to purchase, there's no fee. They're not going to charge you anything for that. What I was referring to, if you're taking your company, sorry, I guess I was on the wrong side of the transaction there.
It's okay. I'm just trying to track, and it's complicated stuff. So
I apologize. I was referring more to if you're going to a broker to sell your business, they'll want to do a valuation of your business prior to them listing it. But if you're
you're muted.
Yeah.
Hit the space bar. If you're selling, they potentially could, would want a valuation as well. And the evaluation could be, depending on, like you mentioned, size of the revenue, size of number of employees, things of that nature, how many years are going to be included in the valuation. They can be, there's two different types of valuations. There's a certified valuation, which is like a full audited valuation, which can, be 10K plus. We do in-house valuations, a simplified method for between 3 and 5K. So there are some very basic valuations that can be done.
Yeah.
Thank
And
you.
this is the cynical Thomas talking here. So take it with a really big grain of salt. All right. Brokers may also try to beat you up on what you want. You may come to them and say, I want $1 million for my business. And they may try to hit you to get you down to something they think they can sell. Because remember that it's all on percentages, right? If you lower $100,000, how much is that commission for them? Maybe 10 grand. But now they have something easier that they can sell. So just be careful of that. Really work with your advisors. Having an outside evaluation is a really good thing if you can afford it. But just I would be very wary of just going in and relying on those brokers, because they do have their own self-interest to close the deal. And if I can take something that's worth $1 million, it's pretty easy for me to sell it for 750, right? So just be aware of that.
Sounds like you should definitely get an outside evaluation.
Yeah. I mean,
why wouldn't you?
Well, it's just because of the size of the deal may not be worth it for you, right? Like if your company's only worth a couple $100,000, you may or may not want to spend 10, 15 grand on an evaluation. Also, it depends on how you got to that value. Is that because you have a lot of cash, or is it because you have an asset that's worth something else, like an IP or something that isn't liquid per se?
Infrastructure.
Yeah, exactly. So, all right, now you got your LOI, and we're going to talk about due diligence and the due diligence process. And this is something that is floating. It's not something that now that you have an LOI, you necessarily start. It can start earlier, but certainly do not start the due diligence process without a non-disclosure agreement, confidentiality agreement in place. But what is the due diligence? The due diligence process is the buyer gathering all of your information to make sure that the amount of money that they are going to put out for your business is actually worth it, and that they're not going to be caught by surprise. For example, like if there was litigation. So what does that process look like? Well, they're going to ask you for a host of documents. Depending on the size of your business, they will probably even come by and walk around and maybe even spend a day or two with you to examine your business. So some documents that they're going to be asking for: financials, typically 3 to 5 years is what we see them going back. Michael may have seen them going back longer or shorter, and he'll comment on that. But those financials will include tax returns, which is where I was saying earlier, having it on a separate return will be really valuable for your privacy, because I have companies that have it all going on their 1040, and now they're sharing that information with other people. And you may or may not, I mean, you may not care, but you may not want to have that be the case. You'll provide things like profit and loss statements, balance sheets, things that Michael will talk about here very shortly. As far as the legal side, what we care about, we're going to want to see those contracts. And that means all open contracts and ones that have warranties still in place. So if you provide really long warranties, you're going to need to retain that so that those buyers know what they're buying. Depending on the size of the transaction, they will actually have an attorney go and read every one of your contracts and look at where the project is to know what kind of liability am I buying. Employment contracts, do you have them? I mean, that's a big thing that I see, is that they don't even have any kind of employment contract or independent contractor agreement. What kind of liability am I buying with the employees? Are there any claims of harassment or EEOC complaint that I might be looking at? Is there any pending or active litigation? For example, if you're in the process of suing a homeowner for collections, that might be a problem for me. Or if I think that there might be one coming down the pipeline, if there's a letter from a law firm saying they're going to sue you, that'll be a problem that you're going to have to disclose. Real estate leases, if whether you own the property in a separate LLC or something, you're going to have some kind of lease more than likely. What do those terms of those leases look like? How am I going to be buying that, and do I want those terms? Equipment leases, your corporate books. So corporate books are generally defined as your annual meeting minutes, your organizational documents. those types of things they're going to want to see to know, am I buying a well-structured business, or am I buying something that the person's been running around for 15 years, never had a meeting, never kept any minutes, maybe doesn't even have an operating agreement or bylaws. And then lists of inventory. So those are the typical things that we see. Michael, from the tax financial side, accounting side, what are you guys usually looking for?
I mean, you outlined it pretty good. Typically, for the most part, it's usually 3 years. Sometimes, depending on the history of the business, they might go back as far as 5. That's a valid point about, if you don't have these separate entities set up, then all that's flowing to your individual return, which it's going to have your spouse's income, any other personal asset or personal income is all going to be listed there. So if you have that separate return, it's definitely helpful. And then I guess the big thing is just, typically you want to have a game plan prior to putting your business for sale, so that if there are any cleanups or things that, like I was talking about earlier, that the discretionary items, those can kind of go away closer to the transaction happening, so that you're getting the highest value possible for your business.
Yeah. So here's the really important thing. So you go through this due diligence process, right? What's the end result? Well, it was 3, really. 1, the deal falls through because it's not even close to the valuation. There's tons of risk. You're in tons of lawsuits. Why would anybody touch that business, right? 2, the deal goes through perfectly fine. It's exactly what you had represented in the beginning. But then there's a third one. And the third option is really where I see a lot of problems come up. They go through the due diligence and they go, well, you have more risk than we really thought. So now we're going to come to the second round of negotiations. So, let's say you established $1 million purchase price in the beginning. Well, now they've gone through the due diligence and maybe they found something they don't like. They're going to try to use that to leverage. They're going to use that as leverage to try to get you to lower the purchase price. That does not happen on all transactions, but I would probably say on 30 to 40% of the transactions we see. And, a lot of them are smaller. So you do run into just them being, not clean books, or something that they weren't expecting to see. But that's a second round of negotiations you need to be aware of. Okay. Does anybody have any questions about the due diligence process before we get on to the types of sales? All right. So
you had a question, right?
It was a minor question. You touched on employment contracts, and I just was questioning. I thought in Maryland it wasn't legal to have like employment contracts.
Well, I think you're referring to non-competes, right? I mean, you certainly can have an employee contract that just lists out their duties. You can have confidentiality provisions in those.
Okay.
You can have non-solicitations, those types of things.
All right.
Non-compete may or may not be enforceable, but that's on a variety of factors, like how much compensation does that individual make. There is a threshold, and there's a threshold in Virginia as well. So for Virginia people, I think there's one in DC, but don't quote me on that. So yes, but you can also see where in that contracts, whether it's employment or your ones with your homeowners, signability clauses will come into play. And we're going to talk about that very shortly here when we get into the 2 types of transactions that we typically see, which are stock sales and asset sales. So before I move on, any other questions? All right. So stock sale is the first one we're going to talk about. Stock sale is the easiest from our position as legal counsel. It's the easiest transaction. So you as the owner, let's say you own 100%, so you have 100 shares. You're simply selling those shares similar to how you do it on the stock exchange, right? You're buying shares on the stock exchange, you're selling shares here. But what does that really mean? Well, when you sell those shares, the buyer is buying all the obligations and liabilities of the business. They're buying it all because they're just stepping into your shoes. And so that's something that may not be desirable from the buyer side, because there may be liabilities I don't want to purchase. And that's why we'll talk about what the asset sale is. But I'll use a really simple example. If your company is being sued for $1 million and you're in the process of going through that suit and somebody does a stock sale, well, you pulled out the old owner, you put the new owner in, they're still responsible for it, that $1 million potential loss. Now it's company, I'm not going to get into all the like liability protections and stuff, but that's a simple example for how stock sales work. Okay. Michael, do you want to talk about the tax implications of a stock sale?
Sure. So we haven't really talked much about C corporations, but I want to bring them into this conversation because a C corporation has 2 levels of tax. A C corporation files a tax return and pays tax separately from the individual. And then if the C corporation pays a dividend to the owner, then you pay tax again on the individual level on that dividend. Why that I'm bringing that up now is because with a stock sale versus an asset sale, a stock sale, I'll go into the implications on an asset sale in a minute, but if you're a C corporation and you sell the stock, it is very similar as any other type of entity. There's one level of tax. It's all taxed to the owner. It's very straightforward with a C corporation. From the buyer's perspective, buyers typically don't like a stock sale because you don't get what's called the step up in basis, where the assets would be valued in an asset sale, and you would be able to depreciate those over future years and get a tax deduction. You don't get that with a stock sale. And so from a buyer's perspective, they typically want to do an asset sale. With a stock sale, it's if you've held it for longer than a year, it's all capital gains, which is at a significantly less than ordinary tax rate. So from a seller's perspective, a lot of times a stock sale is more beneficial from a tax perspective.
Yep. One thing that I'm going to comment on, but this is just from what I see, that is usually a surprise for my clients, is they have started this business, and so their basis in the business is relatively small. And then when they go to sell their business, which is now much bigger, they have a big tax implication. And a lot of them don't think about that until it's a little too late. So again, I hope you can see the theme. A lot of this is just early structuring, right? Yes, David.
So that begs the question, how do you avoid those tax implications? And especially in Addie and I's situation where we'll be transferring it. Should I sell it to her for a little bit of money, or?
Well, are you guys are married? Daughter?
No, daughter.
Sorry.
It's bad video. Everybody wants to come on and laugh now.
Well, so yeah, when you get into, as Thomas mentioned at the beginning, when you get into transfers within family members, there's lots of different ways to structure those that are very tax advantaged, because you've got both sides being able to work together so that the overall transaction and everyone involved pays less taxes. So it's very when it's family members, it would be very customized to make sure that the least amount of taxes as possible is paid.
Yeah, and you can also wrap in like estate planning with it to lower the taxes further with like gift transfers and those kind of things.
Okay.
But that's highly specialized for the CPA route, and I am so glad that I don't have to discuss that, but I'm happy to structure it. But yes.
Well,
so
do you get involved in that discussion with the CPA?
Yes, because we're the ones writing all the legal documents, so we would help draft the actual transfer, but it's big tax implications, and we're not tax attorneys.
Patty, we need to add that to the list of things to talk about.
So
Thomas, going back to what you were saying, like with your example of, you started the company with nothing and now it's worth something, and you're the only owner. Is it, and so what you're saying, or what I thought I understood between you and Michael, is that, okay, so you would be receiving the funds, but it would all be taxed at the capital gains rate, not at a regular tax rate.
Yeah, not typically ordinary income. Correct.
Okay.
So it is better. I mean, it's, but
It's still taxed.
still taxed. Yeah. The IRS needs their share too.
Less than they charge you otherwise, but it's still taxed.
Right. Now,
Is there any benefit then to doing it like either as a self-finance, or if it's somebody internal that wants to buy, slowly transferring those shares?
Absolutely. From a tax perspective, you're only going to pay tax. That's what's called an installment sale. So you'll calculate an overall gain, but you only pay tax on that gain in proportion to the cash that you receive. So you can, if you're looking at the overall tax, unless tax rates change, you would pay the same exact amount of taxes, just 1 year versus multiple years. And then also factor in, if your AGI is getting over certain limits, then potentially you're into higher brackets. So you can manipulate tax brackets the same way by taking payments over multiple years.
Yeah, but there's pros and cons, right? I mean, yes, you can certainly structure it to where you're making less, so you're in a different tax bracket. But if those capital gain rates change, you may have suffered a loss, right? If they go up a lot, it may have been more beneficial for you to take all that in one lump sum payment. And then we'll talk.
If you're getting paid in installments and you choose to take it all as one lump sum, then you might end up having to pay more in tax than you got from the person in that first payment.
Maybe, but the other side of the coin that you need to think about beyond just the taxes is when you do an installment sale, the risk of not getting paid is significantly higher. So it's a short story. We had two people selling their businesses at the same time. One took it all in a lump sum payment, and he took less than he probably could have gotten because it was a single lump sum payment of $250,000. We had another person during the exact same time who did an $800,000 transaction, but he financed it, seller financed it. We are now 4 years in, and we are in litigation, and we're foreclosing on the buyer's homes and in a total mess of litigation because they couldn't make their monthly payment. So which one was smarter in that situation? I mean, I don't think there's a clear answer, but one person got a single check and was in and out versus the other one who maybe got some more, but it ended up becoming a total mess of a show. So those are things you just have to weigh in addition to the tax implications.
And I'll just add, Thomas, I don't know if you're hearing talk or feeling this within your firm, but potential capital gains rates are going up at the end of the year, potentially. And so a lot of people are thinking about making transactions happen this year to take advantage of those lower rates.
Yeah. And so it's a real balancing act. I mean, again, there's not necessarily a right or a wrong answer because you're also forecasting in things that nobody knows, like what are the future tax rates. So stock sale.
Thomas, can I jump in for a second?
Yeah.
So what's the strategy if you guys were recommending a holding company to hold the assets? How does those transactions work for that stock exchange?
So you would, depending on what you're selling, you could either sell the entire holding company. If you were selling going back to my 3 example of the equipment, the real estate, and the operating business, if you were going to sell all 3 of those in just one transaction, you just sell the holding company shares, right? If you wanted to separate it, say I'm just selling the operating business and I'm going to keep the other 2, then you would have you may want to split it off and sell the shares just through the one entity, the operating account. That answer your question, Andrew, or were you having a more specific question?
Yeah, well, that information is helpful, but to kind of phrase it a different way. So a lot of us aren't structured right now to have a holding company. So if we're not structured that way, what are all the ramifications around creating that structure? Like if we're all just self-owned LLCs or S corps right now, how
Yeah.
would you get into that holding company hierarchy? And then what are the tax ramifications around that?
So I'll leave the tax ramifications to Michael, but the creating it from the legal perspective, you would just create that other entity and then you would transfer all the shares up. So let's say it's me and partner John, and we own each 50% of Thomas's LLC, and we want to create a holding company. We would create Thomas's holding company, and then we would each sell our shares up to Thomas's holding company, and then Thomas's holding company would own 100% of Thomas's operation or LLC or whatever I called it.
So that would need to be a transaction to
about a
sell that.
I'm sorry, Andrew.
That would still be a transaction. That would be a sell and a buy of stock interests.
Correct. Yeah. Now, Michael can talk about the tax implications of it.
Yeah, so I mean, it would be a taxable transaction. A lot of things would come into consideration because that's what's called potentially not an arm's length transaction. So you'd want to have like evaluations done to make sure that there's no, and keep in mind too that when that happens, the basis is now changing on that sale. So it is, it's a taxable event. It could result in tax being paid. You can mitigate as much as possible, but that potentially could happen when you do that.
Yeah. Does everybody understand what we mean by the term basis? Okay. All right. If you don't, let us know so we're making sure we're clear on that. But stock sales in general are very simplistic from the legal side. Maybe not so much from the tax side, but the actual documents that we make are very simplistic compared to an asset sale. It's just we're going to buy 100% of the interest, and that's it. Now we're going to talk about an asset sale, and we're seeing a lot more of these. I would probably say 80-20 asset sales to stock sales, because they are more complicated, but they have better tax and liability protection. So an asset sale, what you have is you have the business you're buying, the selling business, and then a separate LLC that is buying the assets. So unlike a stock where it's just buying into that one company, there's two companies involved. Okay. And the buying company is buying particular assets. Now, you can do something like all assets, which in my view is improperly done when lawyers structure it that way, because that's not technically what you should be doing. The thing that makes asset sales more complicated is the ability to pick and choose the assets that you're buying. So I can take all the good contracts and leave all the bad contracts with the old company. And so why do these buyers like it? It's because I can buy the good stuff and leave the potential liabilities with the old LLC or corporation. So types of assets that you might buy that are considered assets. A lot of people don't think of them as assets. Contracts we've already talked about. That's where the assignability clause that we talked about earlier is going to come into play. Other things, names. You can buy the name of the company, and that's an asset. Now, it's not the legal title name like Thomas's, operation business LLC. That's still a state incorporated name. But if I trade it as Thomas's Best Remodeler, then I could sell Thomas's Best Remodeler and have the other entity owning it. The other thing that you can sell, which is really more of a tax thing that I'll let Michael talk about, is goodwill. And that'll have really big implications on the tax side. And what's really cool about an asset sale is the ability to kind of pre-negotiate how you're going to treat things for tax purposes. And that's why you get these buyers wanting to do it, because they can structure their taxes a lot better through an asset sale than through a stock sale. Michael, you want to handle the tax stuff?
Sure. So as Thomas just mentioned, intangible assets like goodwill are taxed at capital gains rates, which again, those are typically lower rates, but Hard assets can sometimes be subject to ordinary income tax rates. So you've got, if all your vehicles are fully depreciated, you have depreciation recapture, and those would be taxed at an ordinary income rate. In addition to, I mentioned the C corporation. If a C corporation sells its assets, it actually results in double taxation, because the corporation is first taxed on the sale of the assets, and then when proceeds are transferred outside of the corporation to the individual, they're taxed again. And then so you got double taxation there. And then if an S corporation was previously a C corporation, there's something called a built-in gain. And if you sell within a 10-year period of a built-in gain, then potentially it could trigger what's called big taxes, which is in addition to any regular taxes on the sale. And that's a very complex calculation that takes into consideration income prior to being an S corporation, if you're a C corporation prior to that.
Michael, can you also talk about retained earnings and how those come into effect sale? We see that a lot of small businesses have retained earnings, and then you have to kind of carve those out in an agreement. Why don't you go ahead and describe what retained earnings are and then how they come in?
Yeah, absolutely. So retained earnings is income that's built up in the LLC or S corporation over years. So if you've had profit over years and you have not made distributions, taken any money out of the company, then that will all lead to your retained earnings, which comes into the calculation of basis, which when you're selling, you're looking at retained earnings, you're looking at distributions over the years, and that'll all contribute to your basis, so that if your basis is, let's just say 500,000 and you sell for $1 million, you're only paying tax on the $500,000 gain.
Yeah. The other thing we see is the ability to take that money out of the company tax-free. And so we always are looking at, well, does the company have any retained earnings that you can take out, and then negotiate that into the deal with the buyer to make sure they understand that you're going to take out some money. As I mentioned earlier, they usually want to see some amount of working capital that's going to stay in there. So if you have $500,000 in your operating account and you have retained earnings of 200,000, well, they need to know that they're only getting 300,000 worth of working capital, and you're going to take that money out tax-free. So
what if it's 5 and 5? So retained earnings are 500 and cash is 500. You're selling for $1 million, but they want to keep the 500,000 in. Does that get structured out? Can you take the $1 million without getting taxed on the second 500,000? See what I mean? The question makes sense?
I think so. So in that scenario, you basically your only asset is the cash. It would be, you'd have a $500,000 gain in that.
Right, but you'd be able to take $1 million, and only as the owner selling, you'd be able to take $1 million. Your capital gains would only be on the 500.
Exactly. Yep.
Great.
Yep.
And the other thing, with an asset sale, things like accounts receivable, those would be taxed at ordinary rates versus capital gains. So that's a lot of times that's a big one that's going to result in a significant amount of tax.
Yeah, and let's talk about accounts receivable real quick, because there is a term that we see in almost every contract that we usually fight really hard to strike, but it's a very simple clause. It just says seller is going to guarantee all the accounts receivables. So what does that mean? That means you're guaranteeing that 100% of your accounts receivables are collectible. So what happens if they're not? Well, then they're going to get money back. And so we fight that very hard, because we don't want our seller to have some ramification down the road that they didn't expect because somebody didn't want to pay. So those are terms that you just need to be aware might be in there, and then that you need to negotiate those out.
So you're using the word accounts receivable. You're actually talking about remaining contract payments, all remaining. Okay, so essentially what we might refer to as contract backlog.
Yeah, exactly.
Okay.
So
Accounts receivable is what we billed yesterday, and the day before.
oh, yep. All right. So
No, I'm just
as long as we're all on the same
clarifying.
page what it means, that yes, but that is really important because a lot of people are looking at it going, well, I need to make sure I collect everything. And that's a very big thing to ask a seller.
On the backlog.
Yeah. And anybody have any questions about the types? I mean, we didn't talk about the purchase agreement. We talked about a couple of terms. The purchase agreements are 20, 30 pages. They can be shorter, but typically what we see is 20 pages. I'm not going to bore you with that, mainly because it's more important to know about the stock versus the asset. I am going to talk about 3 more documents that we're going to deal with afterwards that are going to be part of the transaction that you need to be aware of. But before I do that, does anybody have any more questions about asset sales or stock sales?
I do.
Great.
So so if I were to do an asset sale, but I still have stock, the stock also moves over, but what they're buying is still, so that's where I'm a little confused.
Yeah, let me explain that a little bit clearer. So the reason that with an asset sale, you have the 2 entities is they're just picking out particular assets. Your entity still survives, which means that you still hold all the stock to it. And that it's just a shell at that point. They've come in, they've taken all the good parts and they've left the shell and you still hold that shell. Does that make sense?
So if I'm a corporation and the only thing I have is the stocks, right?
Yep.
So, and they've bought all the assets, then do I just close the corporation down? They haven't bought that?
You could close it down, or I have some that when they do seller financing, they'll leave it open until all the payments are made. But yeah, it's essentially just a shell that you keep around. You can close it, keep it open. It's going to depend on what kind of structuring you do for the payments.
And what typically happens in that? Does the person buying then create another organization, an LLC or a corporation or something like that, and they move the assets to that?
Correct. Which is why that assignability clauses for your contracts is so important, because you're moving it over from company A to company B.
Gotcha. Okay.
Okay.
And if they're buying, like, I'm sorry.
No.
So my company is Grossmiller's Design Consultants Incorporated, right? But we're starting to say something about if it's an incorporated name, that actually can't be bought, but Grossmiller's is a family name. So is that a name that can be bought?
It could be. Yeah.
Yeah, you can sell the name, Cindy.
Okay.
Yep. And that's just,
you sell it as a name.
The goodwill that's tied to it, right? And that's why.
Not that anybody wants 12 letters of Grossmiller in anything, but yeah.
Think of GE. Think of GE Appliances, which most people know, some people don't. It's actually owned by Haier, which is a Chinese company, but they've got a license until 2065 to use GE Appliances Inc. But it's owned by Haier over in China.
Gotcha.
So,
okay.
But they bought the name so that it would be invisible to the consumer.
Yep.
But Cindy, you've built a good name for your business, so there's some value in that. And there's plenty of businesses, Michael and Sons, and there's so many businesses out there that the person owning it is not what the business is named after.
Right.
Exactly.
But you do have 12 letters. Is that how many?
That's how many's in there. That's why I go by McClure now.
All right. Well, if there's no other questions about that, we're going to finish up our time with talking about the 3 other documents that you're going to want to be aware of. So in the event that you are having an owner transition period, so that is where you come in, whether it's through stock or an asset, it's going to be set up as a separate employment contract or an independent contractor agreement. So being aware that you're going to have that as typically a component. Obviously, if you don't have a transition period at all, you won't have this component. But the vast majority of the transactions will want some kind of transition to hand off the customers, to introduce them to this business so they don't feel like, well, it was Thomas work in the business, and then all of a sudden he was gone, and now I'm not going to go with this business because they want that continuation. Whether it's an employment agreement or an independent agreement, contractor agreement, will be based on your particular situation and how you want to be taxed, whether you're going to get benefits, those kind of things. David, you had a question?
Well, if you were doing some kind of an installment sale, wouldn't you want to make sure you're a participant in the business until you get your money?
Yeah, depending on what they're having you do. Yes, but I think one thing you want to make sure you don't assume is that they're going to be having you in control.
Right.
They may.
No, if it's going to be successful, you need to transition that control to them.
Yeah.
Yeah.
So yeah. So that's how you would structure it. And I do have a lot that say, hey, I want to still stay on the health plan. So like I do want to be an employee. And then they just structure how long is that going to be for. Also, where we see this a lot is licensing. So like if you're the designated employee for your like Virginia license, for example, that person that bought in, that company that bought in may not have the qualifications to get the license. They may need to get it. And so you may stick around as a designated employee for the license. So things for that to consider. The next one is the promissory note. So this is where there is some type of financing, and the promissory note is the thing that says, I owe you this money. Okay. If it's seller financing, you're going to have a promissory note. It's going to have usually either monthly, quarterly, annually. I mean, whatever the terms are, it's really up to you all how you want to get paid. We typically see monthly, but we are starting to see more and more quarterly or annually. But there's things you need to be just aware of. I mean, you're actually getting taxed on the money you receive, which we've already discussed. But what is you're losing that control, and so how do you know you're going to get paid? And that's just a risk you have to factor in. Now you can do things like what are called confessed judgment notes, which confessed judgment notes say that if they don't pay me, I get to walk into court and immediately get a judgment against them for this certain amount. And those are very valuable. That's what we just did in the last one I was telling you about, where we're foreclosing on all the homes. We used a confessed judgment, and that provided some security for us. Okay. The last thing is just some internal documents. So you've now contemplated selling, you've even sold the business, you've had your closing, a resolution put in the company books saying that we've approved the sale, that it's for this amount, and just documenting that for your own internal purposes can be really important. You'd be amazed how many times people will pull operating agreements from like LegalZoom, and those operating agreements will say you can't transfer the document without unanimous approval in writing. Well, you never put it in writing because it's just you, right? So having some kind of resolution so that there's a smooth transition in your corporate book to show that it was approved by all the shareholders is an important thing to have. Michael, do you have any comments on the three documents I just discussed?
I don't think so. I mean, from a tax perspective, it doesn't really have much of an impact.
So where we see a lot of tax implication is really in the employment independent contractor component, just how they're going to be structuring it for their own purposes, but it is fairly minor. Does anybody have questions about those three documents? I mean, those are really ancillary documents, but you do usually negotiate all that stuff up front. So when you do get to the signing, you're just signing all of them at once usually. But we got about 26 minutes left, which is exactly what we were hoping for. We wanted to have a good Q&A period. So does anybody have any questions that we haven't addressed?
You asked the question before about basis, and I just want to make sure I'm clear on basis. So can you define that?
Yeah, so basis it's composed of a number of things. So income to the company would increase your basis. Losses would reduce your basis. If you're contributing money to the company, that would increase your basis, and any distributions taken out of the company would reduce your basis.
So basis, a good way to think about it is if my basis in buying this computer is $100 and I sold that for 150, I don't get taxed on the basis because I already invested that money. I only get taxed on the difference. So I get taxed on the $50 difference that I gained.
Are there strategies to increasing the basis that are within the framework of legal activities?
I mean,
Well, I mean, so
beyond
like,
broad, keep the flying.
No, I'm just like, I mean, shareholder equity or loan from shareholder, like, I mean, are there strategies in terms of like compensation or like, are there strategies that you suggest to get that basis as high as possible, especially if, I mean, I'm looking at a 10-year horizon, so I got plenty of time.
so if you're using, you mentioned the loan to shareholder, if you're using that instead of, from an accounting perspective, if you're recording distributions as a loan versus booking those to equity, that would be a loan that would need to be satisfied as part of the sale anyway. So that's really not going to help anything. Not taking all the retained earnings, not taking all the cash out of the company is probably the biggest thing is to help with that. Depending on your assets as well, if you're writing off all your assets, your fixed assets and things like that, if you're writing all of those off in year one, that's going to reduce your basis. So if you
That's going to reduce your basis or increase your basis.
So when you purchase that asset, that vehicle, it's gonna have a basis of whatever your cost is. But as you write it off in terms of depreciation, that will reduce your basis. And if you do Section 179, or if you write off that asset all in 1 year, your basis is going to be zero in that asset if you've written it off 100%.
Right. We depreciate all of our assets.
And it's typically a great strategy in terms of today's tax, and what you pay tax this year on. So it's typically a good way to reduce your current tax bill.
Yeah, and one thing it's one of my favorite sayings. It's, don't let the tax or the legal tail wag the dog, right? So like, you probably should be depreciating. So it doesn't mean don't depreciate your assets so you have higher basis so that when you come time to sell it, you maybe are in a better situation. So just a little.
Yeah, you typically like just like you mentioned, like you're getting between 30 to 40 cents on the dollar for a tax deduction. So it doesn't make sense to spend money just for tax purposes because you're only getting 40% on that dollar.
That makes sense.
It's better to just make money, right?
Yeah, make money.
Well, yeah, I mean, the clear answer is keep cash in the business as retained earnings and pay all your tax returns. And then at the end of the day, that money is actually the clear money that you can extract, right? I mean, yep. Am I oversimplifying it?
No, I mean, it's simplified a little bit, but that's typically how it works.
Okay.
But Keith, you can't take all of that out because although it may be retained earnings, then you have no working capital.
Yes, I get it. And that's kind of the question I was trying to ask earlier, right? Which maybe I can ask it a little bit more clearly. Let's say that the easy numbers purchase price is 1 million. There is $500,000 exactly of retained earnings. The purchase price can stay 1 million, and you can leave as the seller. You can leave however you move the $500,000 around. You can get $1 million sale that you're only going to pay taxes on the second 500 above the cash wherever you leave it or however it moves around in the labyrinth of transactions. They get 500 in the business, you've gotten 1 million, you only pay on the second 500,000 the taxes because the $500,000 in the business is already been taxed.
That's right.
Yep.
So if you're making $500,000 a year or $250,000 a year, and that's enough money for you, leave the money in the business and take it out later. I mean, does that make sense? Like if you can live on 150, then take 150. If you can live on 200, then take 200. Like if you can't get to those numbers, and everybody on this call should go get a job to make more than that. But you get to those numbers wherever your threshold is, and you leave the rest of it in the business at all times for as long as you can.
Right. So the only comment I would make, and Michael, correct me if I'm wrong, is you just need to make sure your tax structure, because like that may have a different impact if you're a C corp, because you may not get the benefits you're trying to seek there.
Absolutely, yes. It's more complicated than that, but I think just as a basic strategy.
Correct. And I do want to make a comment. You know, we've talked a lot about structuring with LLCs and corporations, S corp, all this structuring stuff, right? And I was at a tech conference earlier today. Actually, David was there as well. And they made a comment that I think is really valuable here. They said, don't leave this conference and go and just change everything in your business, right? So like, don't take all this structuring and go, oh, we're a corporation now, we're going to change to an LLC tomorrow. First of all, may not serve you any better. And second of all, it may trigger a ton of tax implications. And Michael can probably talk to that more. Yeah, you may end up losing a ton of money doing that, just because of stuff we've talked about today.
Yeah, definitely. I mean, I think it goes without saying, like, definitely seek counsel before making any structural changes.
Yeah. Good. Does anybody else have any questions? We got about 20 minutes left.
Are there points that it just doesn't make sense to set, like if you have a lot of retained earnings in your business, but you really take a hard look at your business and there's nothing else there, should you just close it?
Short answer is maybe.
Yeah, I mean,
thoughts on that?
If there's something of, like, you know, whether it's I heard Michael and Sons talk, like, if there's some value in the name, there could be no physical assets and there still be value.
Yeah.
So I don't know that necessarily you'd want to just shut it down, but certainly if there's nothing of future value there, then that might be the easiest.
Wouldn't it be a balance? It's, you know, if you've got a huge amount of retained earnings that you could just cash in versus, you know, really you do an honest evaluation and there's not much else there.
Potentially, but in theory, if you've got a large amount of retained earnings, you've grown and built something that's got systems in place and processes that have value.
Yeah.
Now, I will tell you, we just did a transaction last month that was the smallest we've ever done in our history, was $10,000 for the sale price. Okay. And that's because it really was just a name. That's all they were buying. They had done zero. They had all this marketing material and they were selling it to an employee and they had no profits. They were losing money. So they did $10,000, which basically covered all the marketing material costs to get them to zero. So that's not the exact situation you were talking about, David, because you're talking about having all this retained earnings, which means you do have a good business. But what I'm trying to say is there was still value in the name that they created, for better or for worse.
Yeah, and they maybe are passing it on to somebody who can make something of it now.
And that's what their thought was, is, hey, maybe the employee can take it and run with it and do better than what we're doing.
Yeah.
I know that our seminar, the last one, was more on valuation and how you determine the value of a company. But we've talked a lot more today about goodwill, names, things like that. Is there a standard, or is there a calculation just for those kinds of aspects to determine what the value of a name is? Because in the last seminar, that wasn't really had nothing to do with revenues and dollars and all that stuff, but it was that extraneous stuff.
Yeah. The more letters in a name, the less it's worth.
No, but Cindy, to your point,
Dang it.
yeah, that's all really hard to value, right? When we are certainly not business valuators, but we've seen a lot, and we go off EBITDA, right? Which I think was explained in the last one. If it's not, I can explain it a little bit. Actually, I got a CPA on here. Why would I explain it? But it's usually some kind of multiple, right? And the multiples we see in the construction field are pretty low, because you're a service-based business. You're not like a tech company. Tech companies can get huge multiples. You don't tend to see that too much in the construction side, but that's how we do it, which doesn't really take into account the names. Those are those intangibles that you just kind of have to see what it's worth out there in the market.
I mean, some of that I think also plays into like how many Google reviews does the name have? Things of that nature will help you in determining, if there's a significant amount of value in that social media realm. So that's something else to take into consideration.
Yeah. Keith,
I was just gonna say, like, what are the kinds of things that you see making up this goodwill portion? I mean, EBITDA all of those numbers get really complicated when, for example, the owner has a job versus when the owner doesn't have a job. And is it EBITDA all of owner benefit, or, it can get complicated. So the 5X is owner has no role, sits on a beach and collects a paycheck, and it's just boom. So now you're 5X, there's net profit. I mean, those transactions are super simple. But when the owner still is around, even as the culture leader, what are the other goodwills? Is it employees? Is it infrastructure? Is it names? Like, what's the list that you see to make it worth more? Like, because some people, I know people very well. Some people only have $50,000 a year in net profit, but they might be taking 2 times the amount out of the business that I'm taking, right? I mean, so that's a fine way to do it. If you're the owner, you get to choose. So, you're not going to, if somebody's taking $500,000 out and $50,000 net profit, they're not going to sell it to you for $150,000.
Right. And that's where you probably wouldn't have a deal then, right? Meaning you would have a very hard time selling a business. You would also have to look into, well, what is the owner doing for that $500,000? Are they an integral part, or are they just sitting back doing a paycheck because they have really good systems in place? Because
in my scenario, the owner was on the beach.
Well, then you could take that owner out, and now $500,000 could theoretically drop to the bottom line. Now you can buy it for a better price because you have a good understanding of what you're going to get next year, right?
Got it.
But
yeah, I definitely sorry, Thomas.
No.
I definitely think that the owner's involvement has a huge impact on the valuation. If the owner is able to separate themselves from the business is way more sellable, and therefore you can get more for the business if you've got all the processes in place, you've got team alignment, all that there's other that's the intangible piece. If you have all that stuff, then your business will sell for more.
Yeah, and this is my approach. This is not, it's just my approach from seeing all this stuff. These numbers get insanely complicated, right? But it really boils down to the old adage of it's worth what somebody's going to pay for it, right? So you may have a business that's thriving, but if nobody's willing to give you anything for it, what's it worth? You just might close your doors one day when you retire. And we see that a lot. We had a client that we were approaching it was a concrete, I think they were a distributor. We approached them. And they said, no, we're just going to close our doors one day and just leave. That's what we're doing. We're not interested in selling. I was like, oh, well, okay, good for you. I mean, that's a plan, right? For better or for worse.
And to that, to the name aspect, I don't know how many of you guys paid attention, but my firm was called Michael Callahan Associates, and we just went through a complete rebranding for that reason, because my role was completely changed. I'm now more of a CEO role, and in the future, if there is a sale, if I'm out of the equation, it's going to be worth more.
Yeah. But names also can have a negative impact. So like if it's regional, that can have a negative impact that you may not think about. So if you called yourself the Fairfax law firm, right? Then you're essentially limiting yourself to Fairfax. You're going to have a hard time going into Maryland. You're going to have a hard time going to these other locations. And that may have a negative impact on you, even though it's created a really good business in Fairfax.
A lot of the businesses that get sold are sold as part of a roll-up or something like that. And then they don't care what your name is, or your goodwill, or a lot of this stuff. I don't know what they want. They just want you out of the way.
Could be.
Yeah.
A lot of those are just looking for your client list.
Your client list, and now they're looking for your employees.
Yeah. Very
and
true.
any materials you have stored around.
I wasn't expecting this to be such an interactive discussion, and I really appreciate that part of it. And
well, good. Thank you. I mean, I
know this is a good discussion.
Yeah. I mean, some of the stuff is pretty dry, but I certainly appreciate everybody's involvement.
Absolutely.
Yeah. Well, Keith asked a lot of good questions. Thank you.
You're welcome. I mean, it's front and center to write kind of a 10 to 12-year plan to make this happen. And I don't think my kids are old enough to take it over.
Yeah. I'm hoping for less than 10 to 12 years.
Well, and mine are old enough to take it over and have no desire whatsoever. So it's like, okay.
Exactly.
And that is the inherent problem, right? So like I have some young girls. I have a 4-year-old and an 8-year-old. Like I would love for them to take over my law firm. What if they don't? And when they get to 25 years old and they go, oh, I'm not going to law school. I'm going to go, be a dentist or a veterinarian or whatever. And then I'm putting all my hopes on them taking over and they don't do it. I don't want to plan that way. But if they become lawyers and they say, hey, I want to take over the family business, great. Now you have some built-in succession planning.
Yeah. Well, going back a few years, all 3 of my daughters wanted to do something else. One of them wanted to be a meteorologist, and one of them wanted to be a special ed teacher, and the other one wanted to be a special ed teacher. Guess which one of them changed their mind? The meteorologist or the special ed teacher? And I paid a nice education for her. But she can't even tell me what kind of cloud that is.
David and Addie, have you talked to other families that have transitioned, like other remodeling families that have made the transition?
Well, the Schroeders are good friends.
Yeah, the Schroeders and Case family.
Okay.
Trish and I have talked about it, and
who?
Andrew bought them out straight out. So.
Right. Anyway, I if you ever wanted another family, I could make some introductions, like how they did it, because it's always different.
Yeah.
And then
the name can stay the same.
Yeah, but there's the kids that are not going to stay in the business too, right? I mean, maybe. I know that was a big deal. Anyway. I also know a production manager who bought a company down in Dallas that I'm sure would be open to having a conversation.
Yeah, Keith, that's a really interesting point that I think is not considered.
Yeah, I didn't mean to I mean, as soon as I went to the family transaction seminar at one of those summits, I was out. I was like, I'm out of here. You know,
That
and,
so one
Yeah.
child gets the business and the others don't. That can lead to a lot of litigation.
Yeah,
Um,
I
Especially
think
as-
Lori-
so many people just in the little bit of time we joined RA. There's a couple in my own group and people that I've talked to just at the summit. So thankfully my
Yeah.
sisters don't want it, so there should not be any litigation there.
Yeah.
I mean,
They seem to think I've earned it by putting up with David for all these years. So
Yeah, that's exactly right. They know you've earned it.
Well,
hey,
and this is-
Addie, I'll sign an affidavit for you. I'll sign an affidavit on your behalf for you.
That will not do a thing with her sisters.
Nah, but it might be fun and entertaining just to have it in place.
But there is something that really is interesting about that family dynamic is you need to make sure your estate plan, your will or trust,
Yeah.
matches up to what you're going to be doing on the business side. Because there are many wills that say distribute everything equally to my kids. Well, your shares of your business are an asset. You've now just told the world distribute them equally, but then you may have something else over here saying give it only to one individual child. And we have been involved in litigation with that.
Yeah.
Especially big
That's
business.
why Addie's given me a year to work this out.
Yeah, I had that topic come up in our most recent estate planning as well, Thomas, which was what happens if you both die, well, yada, yada, yada. But it was definitely a part of the conversation. Because if everything goes 50, like it's complicated. And we could die tomorrow. I mean, that's just the fact. We could, die today.
So when I do a lot of partnership agreements, like they'll bring me in and they'll do the operating agreement or whatever. I'll actually put in there that the individual owners are going to modify their wills or their estate plan to reflect what we're doing with the shares. And so it'll simply say all of my assets except for any business assets, those are going to be governed by whatever business governing document we have, whether it's an operating agreement or a partnership agreement or whatever.
But
So
you have
that-
to modify your will to go along with that.
Yeah. So then it's very clear if you die tomorrow that the probate court is not going to look at that and go,
Yeah.
well, it's distributing all the assets. They know, okay, these shares have a different governing document. Let me go look at that. And then it clearly says who those shares are going to.
We'll put that on the list for us.
Just add to that list, right?
Yeah.
Well, it's better to plan over time with a strategy. No strategy is going to be perfect. Best case, maybe 75% versus trying to do it all at once.
Absolutely.
I mean, like, have to sell because you get disabled or, yada, yada, all the different scenarios.
Yeah.
Yep. Absolutely.
So, Thomas, going back to the question about the hierarchy and the different structures, so having a holding company, it'd be best to do that when there's any transactions that took place. So using Dave, you and Addie in that example, then if Addie was to buy the company, wouldn't she then create a holding company that would then buy those shares?
Yep.
Especially given the rest of our structure. Addie's husband is part of the business and has a separate division that this is a commercial. If any of you have commercial real estate that needs to be turned over, Pepe does apartment turnover work where they come in between rentals and get it ready for the next one.
yeah, I'm not paying you for that.
I know. I know.
Get that referral fee, David.
Yeah.
So in that particular example, then I haven't talked to Dave or Addie about this, so I'm not putting you on the spot. So I'm just doing hypotheticals going down the rabbit hole a little bit, then there could be a different transaction that would take place. Like if Dave was to put his assets in a asset holding company, which might reduce the actual appraisal of the company, like the valuation of the company, which could potentially reduce the purchase price that Addy would have, but there could be a lease agreement included in said company to do all the rentals off of that fixed asset company,
Yep.
for example.
Yeah, I'm following you. You could do that. You might have some tax implications with him moving the assets from one company to the other. Michael, do you have any comments on that?
Yeah, I mean, that's the great thing about, when things are transferring between families, there's so many different planning opportunities. It could be a situation like the transfer happens over multiple years because of, different family members' tax rates. There are a lot of planning ideas around, and it really looks at, you really want to look at the person transitioning as well as the person receiving, and look at both of their tax situations together to determine what's the best way and what's the best structure and what might go and what might not go. Some things are better to go to not even be involved in the transaction and go into the estate for tax purposes. So there's definitely a lot of considerations when you're transferring between family members.
Yeah, not to open a can of worms, but one thing you can do is structure it so that you transfer shares to like children, to where you then become a minority shareholder, so that you get some tax benefits of being a minority shareholder. If there is a sale, you're going to be taxed differently than if you hold the majority shares where you control it. Because your minority shares are now inherently worth less than if you were a majority.
Does that hurt me anyway, tax-wise?
Well, I mean, you're now getting shares for the company, so your basis is probably very low, and then you would be entitled to distributions, and so you would have those kind of just normal tax ramifications of being a business owner.
Okay.
But it wouldn't impact you in the current year, but it would impact you down the road, however you transferred it.
Right.
But and I'm only using Addie and Dave because they're here, but if Addie was getting shares as part of her compensation for the deal, that has to get calculated, correct? Or can you keep that on the
I'm selling them to her. I'm not giving them.
No,
this is all hypothetical.
But Dave, what I'm saying is hypothetical. Let's say Addie makes $200,000 a year, and you take her salary back to 100, but you give her 10 of the 100 shares over 5 years. She's technically paying you, taking less comp. My question is, do you have to account for that in the sale, or is that something that is on the kind of outside of the lines that you could do?
So that would actually be, if that was, let's just, to keep it simple, if you dropped it, whatever the value of those shares are would go into her W-2. So that would be income to her. But it, again, depending on David's situation, her situation, that could be good or bad.
Yeah, I think the
key word I heard in all this was planning opportunities, and you need to talk to your CPA and your lawyer to work out but opportunities. We have more opportunities doing this as an internal family transfer than a sale.
Yeah. It's just opportunity is the perfect word for it. Choice, right? But going back to that transaction where you're giving, or not giving, that's the wrong word, compensation through shares as part of it, you're going to have to establish what the value of those shares are. And so you could say, hey, maybe those shares are worth $10,000 divided by 5. They're whatever that value, $20,000 a share, $2,000 a share. I use calculators.
Anybody holding you accountable?
Yeah, I don't care about the numbers.
But you could attribute that, or do you come up with a different valuation and just say, we are deciding this year the shares are worth this.
$10.
$10. Yeah. Now, that will be her basis in it. Michael, correct me if I'm wrong. I'm going in the tax realm, but that will be her basis because they are compensated. She's received them through a compensation plan and paid for them essentially.
Yeah. But you could transfer them at book value established by you, regardless of some future sale value.
Correct.
And this would all work. I mean, I
It's
know
kicking
it
the can down the road.
yeah, but it's also like if Addie and Dave are talking about 5 years, talk to your CPA. There could be some savings there.
Well, you do have the ability just to say, and as long as it's reasonable, again, the IRS typically is okay with it. I mean, Michael, correct me if I'm wrong, but like if you establish a fair valuation for your company and your shares, they'll kind of go along with it for the most part. Now,
But if you say $10, then they won't.
exactly.
Yeah.
Like if I say, hey, I've got a $4 million business, but my shares are worth $10 a piece and I have 100 of them, that's not going to work.
There
1,000
is a
shares.
confidentiality agreement to this call, right?
Well, it's only being recorded and distributed, so
On the YouTube, on an open channel. No, but hey, Dave, $200,000, 1,000 shares, $2,000 a share.
Sold.
No, but I mean, that's a reasonable valuation. Who's going to oppose it?
Yeah.
Michael, any comments on that?
No, I mean, so the reasonable comes up in a couple different areas in the tax world. Typically where we see it a lot is when it comes to an S corporation and the compensation that the officers are getting. That's where I see that line being crossed a lot, where you're getting a $20,000 salary and you're managing a team of 20 and you're doing $2 million in revenue. And you're getting paid a $20,000 salary and you don't have support. So that reasonable, anytime you see that reasonable term used in taxes, you want to make sure that you have documentation and support for whatever that is, whether it's a stock sale or a company valuation.
Good. Well, we ran a little over, but I greatly appreciated the conversation. I thought it was very good and spirited and a lot of good knowledge.
Are we allowed one more question?
Sure.
All right. So how is your basis figured out? What's the calculation to do that?
So I talked a little bit about that earlier. So it goes up. It goes up based on money you put into the business. It goes down when you pull money out of the business. It can go up by income generated from the business, and it goes down from losses from the business. That's the long or short. There's also, if there's liabilities within the company that impacts your basis, but that's the simplified method.
So you'd have to go back to the beginning of time of your business or when you bought your business to start at ground zero and then recalculate throughout history. Is that correct?
Yeah. I mean, yes. I mean, it should, in theory, if the accounting has been done properly throughout history, it's going to be in your equity section of your balance sheet. But a lot of times that's not the case, and so then you have to go back and pull returns and look through all the years.
Mm-hmm.
I gotta go, guys. Thank you.
All right.
Thank you.
Well, thanks, everybody. If you have any questions, just give us a call or an email, and we'll be happy to answer them for you.
Thanks
Thanks
so
so
much.
much.
Thank you very
Thank
much.
you. This was awesome.
Thanks, everybody.
Thank you.
Bye-bye.